Trailing stops, the secret risk management strategy that professional traders use. Did you know that people are 1.5 times more likely to sell a winning stock than a losing stock? That's sad, but true according to a survey of 88,000 investors. That is human psychology. And that's exactly why the average investor is still average. They're losing the game. Put another way, we're twice as likely to sell a stock for a gain rather than a loss. In a short while, you'll learn the strategy that professional traders use to win the game. But before that, let's think about it for a minute. The two most common mistakes we make is that we hold on to our losing investments and sell our winners too early. I'm sure you've gone through that experience. You bought a stock, held on for some time, then sold it as soon as it went up a bit. You later look back on the stock and realize it's gone up even further. What's worse, it's soared. You've missed the opportunity of a lifetime. Why? Don't worry, I'm with you. I've booked 30% profit on a stock only to watch it go up by over 10,000% that year. Yes, 10,000. I feel that pain. But it doesn't have to be like that. Let's talk psychology, the psychology of losing. A survey was conducted on investors to find out what they would prefer. Let me ask you this question. Given the choice between A, 80% chance of winning $4,000 and B, 100% chance of winning $3,000, what would you choose? Think about that for a second. Well, 80% of those who answered opted for choice B, 100% chance of winning $3,000. But when we do the math, we'll find out that we opted for less. Instead of earning $3,200, we are happy with $3,000. We just left $200 on the table. No wonder we don't succeed in investing and trading. Okay, let's change things up a bit. Given the choice between C, 80% chance of losing $4,000 and D, 100% chance of losing $3,000, what would you choose? Let me repeat that question again. Given the choice between C, 80% chance of losing $4,000 and D, 100% chance of losing $3,000, what would you choose? Thought about it? Okay, I'll assume you have. 92% chose to lose more money. That's the psychology of losing. Newbie investors prefer to lose money. It's sad. You may have noticed that both the questions I was asking are the same. The results are identical, but they are framed differently. One is framed as a gain and the other as a loss. This is also ironically known as loss aversion. It shows you'd rather take up the gamble to avoid a loss. And this is why we hold on to losers for so long. And that's where the weakness of traders lie. Now that we've opened up our eyes to the knowledge, it's time to take advantage of this insight and profit from it. We just talked about loss aversion, so I'll repeat this quote just so that it sinks in. People will fight much harder to avoid losing something they already own than to gain something of greater value that they do not own. This is human psychology. We will do whatever we can to avoid losing something that we have, but we won't try harder to gain something of greater value. Try taking away candy from a baby and you'll see what happens, even when you want to give him something better. And here's where we dive in deeper to psychology. Let me tell you the truth. No one has a crystal ball to time the market. If anyone says they can, run fast. Those who try to predict need to be right. They have an ego to cater to. That's why doctors are generally bad traders. They have to be right. And the mindset causes them to lose money. The day you leave your ego outside the door and come to the trading desk is the day you become a profitable trader and investor. In the words of Marty Schwartz, a champion day trader, I became a winning trader when I was able to say, to hell with my ego, making money is more important. I've heard so many versions of ego floating around, and its various forms. Let me share with you some of the invisible scripts that prevent us from having success. Have you heard these? I'll get out when it goes back to some level. Great opportunity. I'm going to buy more because, yeah. I just want to average my cost down. Well, I'm in it for the long run. I'll just wait a year for it to go back to that level and then I'll. You've heard this and more. Have you noticed something in those statements? There's one problem. And once you realize it, you can get ahead faster. Yes. You. You are your own worst enemy. The number one impact on your investments is you. Let that sink in. You are your own worst enemy. Don't just take my word for it. The greatest investor of all time knows it all too well. How come? Well, his mentor taught him that secret. The investor's chief problem, and even worst enemy, is himself. That's right. There are two things an average investor or trader wants: to make money, and a lot of it, and to be right. But that's where the problems start. If he focuses on being right, then he won't necessarily make much money. Stop feeding your ego. Okay, now that we know we have a tendency to love losses, let's find out how to resolve this dilemma. I call this the most shocking table in investing. When I first came across this table, I was shocked. My jaw dropped, literally. Why? Because I realized my mistake. My ego was wrong and the data was right. There's no argument there. When we make a loss, most investors and traders forget how difficult it is to make it back. Breaking even becomes difficult. As you can see, as your losses get larger, it becomes even extremely difficult to break even. If your stock falls by 50%, to recover that loss and just break even, your stock has to go up by 100%. Yes, 100%. How often do you come across a 100% gain in your life? Me? Very few. Said another way, when you maintain laser-sharp focus on the downside of any transaction, trade, or investment, the upside takes care of itself. Remember our famous saying? Remember, take care of your downside and the upside will take care of itself. Everyone would rather think about the gains they'll make or the returns they may receive. When you let those hopeful fantasies control your decisions, sooner or later you will lose big and big time. You become the biggest threat to your own safety. There are various ways to protect your downside. Studies of the top performing traders show that the best stop loss limit to use is around 7%. Remember the previous table? The higher you go, the more difficult it becomes to recover. Another way is to use a trailing stop below the midpoint of the prior price consideration. We're not going to talk about this, but we'll get into trailing stops in detail. You might have noticed that I mentioned stop loss here. But what we're going to talk about is how you can maximize your profits with trailing stops. To understand this better, let's take an example. Let's take Mike, our friendly guy. He's a beginner, but he's been investing for quite some time, let's say maybe 1 to 2 years. He buys 1,000 shares of a stock at $40, so that's $40,000 invested. After he gets in, he sets his trailing stop. You can set your trailing stop as a fixed amount or as a percentage. I prefer percentages, but let's take the example of a fixed amount. Okay, so Mike enters his instruction for a trailing stop of $4, which is about 10% from where he enters. What this means is that if the price falls by $4 from 40 to 36, his shares are sold. Let's assume for now the price rises to 46. His trailing stop is trailing the higher price, which is 46. So $4 below 46 is 42. If the price falls to 42, he's out of his position. If the price falls to 43, which is above his 42 stop, he's still in. Okay, then the price starts moving up to $53. So his trailing stop is automatically adjusted to 49. That's $4 below 43. Now imagine the stock has reached its peak at $53 and starts tanking from there. When it hits $49, he's out. And guess what? He's going to get a gain of over 22%. That's $49 divided by 40. He maximized his profit and minimized his loss. Do trailing stops always apply? Not necessarily. Trend traders, particularly those who use options, actually thrive on volatility, as they can either sell the premiums on puts or swing trade based on technical indicators. But what if you're a value investor? No. Value investors take long-term views, usually decades, but that also means they have the stomach for 50% losses at any point in time and are not afraid of the volatility. At the end of the day, it depends on your risk tolerance, the dry gunpowder that you have, whether you have deep pockets to catch a falling knife or buying on the dips. The conclusion of all of this is know thyself.